Hello, everyone. My name is Reese. You're watching Simple Value, and today I'm going to be talking to you guys about what is a target date mutual fund, what they are, how they work, and who they're for. So, to start off, the idea behind a target date fund is that it's a set it and forget it type of investment approach where you buy one fund that has your target retirement date in mind that will auto rebalance itself over time to allocate your risk for your age group. Now, this is a very calculated way of doing it. It's a very set it and forget it type of thing where, say, you're born in the year 2000 and you're wanting to retire or expecting to retire in the year 2060, 2065, you would select that target date fund that aligns with your retirement age, and the fund managers for that specific mutual fund will automatically select a calculated allocation towards US stocks, international stocks, as well as domestic and foreign bonds, and that they'll change over time. And the idea is that the further away you are from retirement, the younger you are, the more aggressive you can be with your portfolio. So you can have a higher allocation to stocks, while as you get closer to retirement, you will start to consolidate those stock holdings and start increasing your allocation towards bonds and potentially even start holding cash as you get near your retirement age. So, for instance, this is a kind of a visual model. This was pulled from Financial Samurai. This isn't necessarily what Vanguard uses for the funds that I will show, but the idea is there that as you get older, you'll hold less and less stocks and start increasing your bond allocation. That way, you are hedging your risk. You are kind of lowering your overall risk and exposure to the stock market and starting to lock in fixed interest bonds. And the idea with that, the target date fund, the fund managers do all of this for you. So you can just invest in that fund for the duration of your life or your retirement investing, and they'll do it all for you. Now, this is pulled from Vanguard's website, kind of an idea. So you have U.S. stocks in like the pinkish red, international stocks in kind of the mustard yellow, U.S. investment grade bonds in dark blue, uh, Treasury inflation protected securities TIPS. These are inflation bonds, and green is cash. And so the idea is that, and you have your allocation in years to your target date, is that as you get closer to retiring, your stock allocation goes down, your international stock holdings decrease, and you start holding more and more bonds, and then you start holding on to cash as you get close. So on Vanguard, I'm going to be referencing Vanguard's target date fund specifically. Most major brokerages offer them, such as Fidelity, but I'm going to be using Vanguard for this um, explanation. The reason I like Vanguard is that they tend to have very low expense ratios. They tend to have a variety of options, and they're easy to use. Now, keep in mind, if you are getting a mutual fund in a IRA or one of your personal brokerage accounts that's not through a retirement account, typically you will have to get fees to purchase a mutual fund. So make sure you understand those types of fees. Make sure, so if you have a Vanguard brokerage account, you can buy Vanguard mutual funds without a fee. If you have a Fidelity, you can buy the Fidelity one. So it kind of just depends. Whereas if you're purchasing it in a 401k or IRA, sometimes you potentially get more freedom, but make sure you understand those rules. So, like I said, you have professionals that will manage the asset allocations that automatically rebalance it, and you'll get some lower cost, lower expense ratios. An expense ratio, in a nutshell, is how big of a fee you're going to pay every year to have that to be invested in that fund. So typically for the Vanguard funds, they're 0.08% for their target date funds. But getting back into it, so like I said, which target retirement fund fits your timeline. And as you can see, they have the intervals in 5 years. So say you're 2070, 2065, like all the way through. And it kind of gives you a rough years at who this is for. So what years were you born, how far away you are from retirement. And kind of going back to their holdings, let's say you're going to retire in 2050, for example, 0.08% expense ratio. You can scroll down and you'll see it's holding about 55% US stock, 36% international stock, 7% US bonds, 3% international bonds. So, and then if we were to select something like the 2030, it's got 11% international, 25% domestic bonds, 26% international stock, 39% US domestic stock. And the idea there is that as you're getting closer to retirement, you're getting less exposure to the overall stock market and you're getting more asset allocation towards your bond holdings. Now let's look into, I'm going to reference Portfolio Visualizer for this kind of back test. For this back test, we're going to be starting off with $10,000, investing $750 a month. And this is going to be inflation adjusted, so that $750 that you're starting with is assuming it's inflation adjusted. Reinvesting your dividends, and for this comparison, I'm going to show you how the 2050 and 2030 target date fund compare against the overall S&P 500. And then Vanguard also has a fixed fund called the Vanguard Balanced Index Fund, where it is a 60-40% split, 60% US stock, 40% US bonds. And then that gets rebalanced. And the difference with this fund is that it is a fixed allocation. So as you get closer to, there is no target date, there is no redistribution. It's a fixed ratio. So this is called a kind of, historically has been called a balanced fund. And I can, I'll put this link in the description where you can kind of see, but this is from Vanguard, where it's showing the different historical returns and risks associated with different allocations and kind of the risk levels. They're calling growth funds 70% or higher stocks, balanced being 40 to 60% stock, and then income being 20% or lower stocks. And that's going to be if you're more in retirement. So I'll put a link in that description for you to read through. But going back to the comparison, so if we compare the S&P 500 with the balanced 60-40 fund, then the 2050 and 2030 target date funds, you will see that the S&P 500 is by far the big winner. And even if we adjust it for inflation, it's by and large so far been doing very well. Now you have to take a step back and kind of understand what's been happening in recent years. So granted, this is after 2006. So 2008, we had the Great Recession, we had the financial crisis, and after that, we had a period of a huge bull run where the Federal Reserve had low interest rates. And when interest rates are low and you have your low interest bonds, your bond funds are going to start underperforming compared to the overall stock market. So you have this huge period where interest rates have been historically low. Now they're starting to go back up. We know that right now the US interest rate, I believe, is the Fed has it at 5.25% or so, and that's expected to potentially continue. So as those rates go up, the bond funds should start giving you a higher interest return. But from my belief, I believe that the main discrepancy here is that, yes, the 100% stock, assuming you invested in the S&P 500, is going to perform the best when you have a time period of a bull market. But if you think back and look back in history, there have been time periods where bonds have provided really good leverage or hedge towards an overall downturn. So if we look at the overall returns, the 2050 target date refund since 2006 averaged about 7% return. The 2030 fund averaged about 6%. The 60-40%, 7% per year, and then the S&P 500 9.4% since 2006. Now, if we look at the drawdowns though, in 2008, 2009. As you can see, it might be hard to read, but the 60-40 fund dropped the least at 32%, and the others dropped. The other target date funds that had exposure to bonds dropped less than the overall S&P 500. Same thing again during COVID. But now in the 2022 sell-off where you had interest rates on the rise, and when interest rates are going up, older bonds lose value. And so that was the worst year for bonds on record, I believe. So the target date funds and the 60/40 portfolio were hurt pretty bad. But even then, the 60/40 fund had less risk. So it's important to understand the purpose of these funds. So yes, in a bull market or in a U.S. bull market, the U.S. stocks such as S&P 500 will overperform other asset types. You have to understand that that can change over time. And the idea here, especially if you're about to get into retirement, you're not wanting to get into these. You don't want to have a risky portfolio because you want to have something that you can rely on, whether you're relying on your bonds income or bonds to lower all your portfolio risk. That way, when you have to sell some of your portfolio to fund your retirement expenses, you have a reliable fund to pull from. So I'll put links in the description for you guys if you're interested to go through and kind of look into it yourself. But that's kind of a general overview. So in a nutshell, target date funds are a set it and forget it fund where the fund manager auto selects allocations towards U.S. and domestic stocks and U.S. and foreign stocks and bonds to fit your age profile. And as you get closer to retirement, that fund allocations will change to take on overall less risk. Some of the cons with this strategy is that it's very fixed, meaning that there's not really any wiggle room. It's very calculated for what the allocations will be. And you have to understand that you will underperform 100% stock. So it's not looking at this back test and be like, oh, the green S&P 500 did the best. You have to understand why. So all these bonds have been basically holding back the overall returns of these target date funds. But if you're about to retire, you should be transitioning to a phase where you're looking to protect your capital rather than grow your capital. So my personal opinion, granted, I'm not a financial advisor. I'm simply trying to share information. I do believe that I currently do not hold any bonds in my 401k. I'm 100% stocks. Granted, I'm in my early to mid 20s, so I'm going full stock. And over time, I may start changing that as I get closer to retirement. But as of right now, I'm willing to take on additional risk because I have a longer time frame. But you have to understand your own personal risk profile. How much do you even want to manage it? Do you want to just purchase one fund and just never touch it? And that's the idea with these funds where they do everything for you at a pretty low expense ratio at 0.08%. So I'll put links, like I said, in the description for you guys to check out. If you guys have any questions, feel free to leave a comment in the description or comment below, and I'll see if I can help you out at all. Hope you guys have a great day. Hope this was helpful. Peace out, everyone. See you later.